Welcome to The Path to Exit, a podcast to help software and internet founders understand the process to raise capital or sell their business.
Hello and welcome, everyone. I'm Mike Lyon, founder and managing director at Vista Point Advisors, and this is The Path to Exit. This show is dedicated to helping founders of software and internet businesses understand what it takes to raise capital or sell their business and how to do it well. My guest today is Jeff Bean, managing director at Vista Point Advisors. Jeff and I have worked together for over a decade, advising founders throughout the transaction process. One of the questions we get asked the most is about the timing of an exit. When should I sell my business? When should I raise capital? We often recommend selling during a growth phase, which can feel counterintuitive. Why would I sell when I'm winning? We often refer to this as the entrepreneur's dilemma, and it's when the business is going really well, you don't want to raise capital or sell, but of course, that's when the buyers and investors are most interested. We discussed some of this in our very first episode, but it comes up so often we wanted to circle back and cover this in more detail. Jeff, thanks for joining me.
Yep, happy to be here.
To set the table, maybe talk a little bit about how do buyers evaluate and reward businesses that are growing versus maybe businesses that aren't growing as fast? What's the real impact there?
Well, first off, I would say that growth in general, it kind of eases all buyer concerns. It's incredibly powerful, particularly if we have growth acceleration in the business. Buyers, as they think about opportunities, they're always trying to understand what does the founder know that they don't know, right? Thus, why are they selling? And having growth, and particularly growth acceleration, it really eases this concern. Now, not all growth is treated equal, right, in terms of different scales and growth points. And so that's maybe important to dive into that a little bit in terms of how much it matters at different thresholds. So the way we think about thresholds is there's kind of breakpoints in valuation where valuations step change as the business continues to scale. And the 3 or 4 thresholds that we really think about is a 5 million ARR threshold, a 10 million ARR threshold, 20 and 40. And if you're at those thresholds with equal growth, you're in general going to get a little bit of a valuation premium. In terms of the growth breakpoints, there's different kind of thresholds there as well. If you're growing sub 20%, if you're growing 30 to 50%, if you're growing 50 to 80%, north of 80, north of 100, those are different valuation thresholds. And that's really the key aspect around how do you get credit for your growth, but also capture that scale that you're at. And that's where we see a lot of our clients optimize around local maximums for valuations based on their scale and the growth rate that they're achieving at the time.
That's fantastic. I think you just can't express this point enough around how much growth matters. If you're sub 100 million, 200 million in ARR, no one is really buying you for the scale that you have. They're buying you for what you're going to be in the future. Now, if they're buying $1 billion business, they could just be buying you for your revenue and thinking about cost synergies and ways to drive the margins higher. But if you're a smaller SaaS business, people are buying you for your future. And so that growth rate becomes super important. One of the things we found with some of our founders is they tend to think any type of transaction is an all or nothing kind of thing, right? I'm either giving up control and I'm done, or I maintain full sale of the business. Jeff, maybe talk about some of the common deal structures and the differences between them, just so we give founders a sense for the potential menu of options, but really think about this as a spectrum.
So the 3 core types of transactions that we think about are minority transactions, majority transactions, and full sales. So a minority transaction is exactly what it sounds like. You're selling less than half of the business and you're retaining control. And so in those type transactions, say you're selling like 30 or 40% of the business, you're taking some chips off the table probably. That's likely going to be a big chunk of liquidity, and maybe there's a small amount of growth capital involved in that. And you keep a lot of upside, right? You keep 60, 70% of the upside in the business. A majority transaction is kind of just the flip side of that. So you're selling somewhere between usually 60 to 80% of the business. So you're taking a healthy amount of liquidity off the table, but still maintaining significant upside, right? There's still tangible equity upside in that transaction. And then a full sale transaction, it really depends on who you're selling to and what that looks like in terms of the makeup of the consideration. If it's a full sale to a big public strategic, so take like selling the business to Google or someone like that, that's obviously a full cash out, right? You're getting cash for the company. There's no point really considering the equity in that scenario, because if you wanted that equity, you just go buy it out in the public markets. But there's also a lot of transactions that take place in today's market where, say, it's a full sale transaction to a private business, and there's different private businesses, right, that are different scale thresholds. And some of those businesses could be, frankly, not that much bigger than our clients. And then there's oftentimes really large private businesses. And so those transactions, while it's a full sale, there could be a combination of consideration where it's not all cash. Maybe it's 80% cash, maybe it's 70% cash, maybe it is all cash, but those transactions are obviously giving up control, but there's different degrees of liquidity involved based on, frankly, what our client wants to do and do we like that equity or not.
As we're advising founders, one of the things we encourage them to think about a lot is, as Jeff said earlier, the valuation's very tied to the growth rate. The multiple is very tied to the growth rate. There's obviously some other factors, which we've covered in other podcasts around SaaS metrics, but that growth is probably one of the most important factors. And if you're a business that's 2-3 million in ARR and you're growing at 40%, maybe that's adding like 800K of ARR to the business. That's very different than if you're at 5 to 10 million in ARR and you need to grow at 40%. So you have to do many things at once to be able to keep growing the business at 40%. I think a lot of folks think, well, I grew at 30, 40% last year. That's probably what I'll grow at this year. That's okay when you're sub 5 million in ARR. That's likely to happen. When you get above 10, 15 million in ARR, you have to have a lot of different things going at one time. And what becomes particularly important is scaling sales and marketing. And this is where, we feel like bootstrap businesses can struggle the most because they don't have that experience. They tend to be product folks who have nailed product market fit. It's also an area where an investor can help scale sales and marketing because they have a lot of experience. So definitely think about the math of the dollar value growth you have to add to stay at the same growth percentage trajectory. That math just gets harder and harder, and why you see some of these deals done. The other thing we just want to do is walk you through an example of exiting in stages. Again, I mentioned a lot of our founders think it's an all or nothing kind of thing, but think about this common scenario. You're a business that's 10 million in ARR. If you did, let's say, a minority recap where you sold 40% of the business, and let's just put a 10x multiple on that business, just keep the math simple. So 10 million in ARR, 10x multiple, that means you're worth 100 million. And let's say you sold 40% of the business, so you got 40 million of liquidity. And over the next 3 to 4 years, you made some investments in sales and marketing. You continued to grow the business. Now you're a 30 million ARR business. And let's just use the same multiple. In reality, if you kept up that growth rate of 40%, the higher scale would give you a higher multiple. Let's just say you get 10x. So now you're at a $300 million exit, and your total liquidity on that transaction would be 180. You add that to the 40, you're at 220 million of liquidity. So obviously great outcome for a founder. Let's compare that to not doing the deal at 10 million in ARR. So you grew from 10 to 20, slower growth because you don't have the focus on sales and marketing. Your multiple probably comes down now to something that looks more like 7x. Now you own the entire business, so you got 140 million in liquidity versus that 220. So obviously there's a pretty big difference there in terms of the total liquidity you got, but also just think about it from a risk profile perspective. You were able to take $40 million off several years earlier. Basically, no matter what happens with the business, you're going to be good, and you get to go be more aggressive in growing the business. I think that's the math that really makes sense to us. Now, if you do a 60 or 70% deal, that gap starts to change a little bit in terms of how much you're giving up. But I think it's a really instructive example in taking some money off the table, allows you to diversify, allows you to take care of your family, and you still maintain a lot of upside. So anyway, think about that math and what makes sense for you. So Jeff, we've talked a lot about the valuation impact and the liquidity. Can you talk a little bit about maybe some of the other non-valuation related reasons why a founder might want to exit in stages rather than do an all or nothing type transaction?
Absolutely. So I think some of the reasons that we hear from our founders is just having the concentrated financial risk where they have a big chunk of their wealth tied up in this private illiquid business that is relatively risky, right? And so I think that's an area where just that diversification play becomes a big driver for a lot of our clients. And I think just the growth profile and how they manage the business changes. So a lot of our founders, we hear often where when they first started the business, they were very much risk seeking, right? They didn't really have a lot of value creation yet. They were just getting product market fit, and they were just growing the business and kind of taking all the risks that they could because there frankly wasn't a lot of value to defend, if you will. But as the business continues to grow and as they're successful, sometimes some of our founders talk about how they become more risk adverse and they're not able to be as aggressive as they were when they started the business because they're becoming more protection area of what they've built. So I think that's definitely a component of it. And then just the challenge around the unpredictability of growth plateaus. I think you hit on this a little bit, but growth comes sometimes in waves, and being able to execute on the different life stages, if you will, of the business in terms of how you grow it. So going from product market fit to scaling sales and marketing to trying to create more of a community or a flywheel around your product and growth. There's just different avenues for how businesses grow at different stages. And I think that's an area where a lot of our founders find some help by having other professionals that have executed on that stage of business into the boardroom and helping them grow it.
Great points. And I think the unpredictability of growth is something that founders struggle to understand. And frankly, it's one of the few downsides, I think, relative to venture-backed companies, because what we tend to see with bootstrap businesses sometimes is in the early days, it's all about survival, right? So you're focused on product market fit. And I think that usually goes exceptionally well for founders. You wouldn't survive if you didn't have product market fit because you don't have all the capital. But what you tend to see is more uneven, and I would almost call it like herky-jerky growth, right? You unlock something, you figure out the product, you grow, but you don't have enough capital to really invest behind some of the things you should be doing to thinking about growth in 2 or 3 years out. Sales and marketing would be a good example, or maybe integrating payments. And so you tend to have to clear these thresholds, get back to profitability, and then you can reinvest in the business. So sometimes those delays in investment can lead to some uneven growth rates. Now, the beauty is you still own almost all the business. So from an enterprise value, it's still good for the founder, but you do lead to some uneven growth that if you could invest ahead of some of those curves, you would have smooth growth. And I think the most important thing for valuation, other than just the growth rate, is the predictability of that growth rate. So ideally, you'd like to see that nice, smooth growth rate rather than these plateaus and then shifts up. I think the other thing that confronts the founder is once they get probably to like 6 or 7 million in ARR and they could actually generate some EBITDA, it's what do you do with that EBITDA? Do you invest it or do you diversify by taking the EBITDA out of the business basically as a dividend? And there's no shame in doing that, right? That's the way to de-risk. But no, if you de-risk in that way by taking the money out and not reinvesting, you are impacting the long-term growth of the business, which could impact the valuation. So once you get to 7 to 10 million ARR, it could be better to sell 20, 30, 40% of the business and keep the pedal to the metal rather than diversifying through taking EBITDA out of the business. So Jeff, just maybe to hammer this point a little bit more, how effective do you think we are and our clients are at timing the sale, meaning understand exactly where the peak is? You've obviously talked to hundreds or thousands of founders over the last 14, 15 years. How good are folks generally at recognizing the peak and selling at the exact right moment?
It's a great question. The short answer is I don't think anyone has a crystal ball on that, right? In terms of being able to really perfectly time the peak. And what I've seen founders who've done really well on outcomes is they've recognized that they have enough girth, if you will, right? They're a certain threshold, whether it's the 5 million threshold or the 10 million or 20 million of ARR threshold. And that has implications for valuation, right? We talked about that a little bit. So they're kind of at a certain threshold and they're executing well. They feel good about the business, and that's where the multiples are so much richer. And while, yeah, there could be some more upside if you're able to execute and continue to take that risk profile, but they're at a point where if you throw like a 10 to 15x multiple on a 10 million ARR business, that's kind of the valuation paradigm where I think they see success. And being able to execute on that and sell into that strength, the multiple expansion that they get from the buyers who are recognizing that this business is doing really well, they're firing on all cylinders, there's still a lot of upside in the business. That's where people, our client-wise, have done particularly well. And so I think that dynamic around making sure that you're selling in the strength and you're able to convey that to the market as opposed to waiting for that plateau.
And some of the myths out there, I think particularly from the VC community, is this idea that you don't take any liquidity, right? You leave it all riding. I think that's pretty disingenuous because where we feel like founders capture the most value is actually by maybe skipping the VC round, right? You own all the equity when it's at the riskiest as you're getting to product market fit and as you're getting to 5 or 8 million of ARR. There's a tremendous amount of value created in that journey, right? Basically going from a company that has a couple of customers to a company that has 8 million in ARR. You're generating tremendous value because that's where all the risk is. Once you're growing from 10 to 20, there's clearly risk and upside, but it's not in the same way. So I think if you actually go look at the math of the situation, would you rather give up 20 or 30% to a VC very early on when the outcome's uncertain versus maybe selling 20 or 40% to a PE firm after you've already cleared that 8 to 10 million in ARR? If you go look at the outcomes and do the math on what that means for you, it's totally different. So our view would be take less capital early, but maybe get some liquidity earlier, right, than a VC model versus the VC model, which is give away 30, 40% of the company up front and then not take any liquidity along the way, right? And wait till you get to that full exit. So I just encourage you to think about the math of those situations and what the likely outcomes are. Well, Jeff, thanks for joining us. Today, we talked a lot about the growth plateau, how founders should maybe consider selling in stages and how it's not really an all or nothing type of transaction, and would encourage you really to do the math. But Jeff, thanks for joining us. Appreciate the time.
Yep. Happy to be here.
Vista Point Advisors is a founder-focused investment bank that advises software and internet founders through M&A and capital raise transactions. We are a fully unconflicted investment bank who only works for founders on the sell side, so you know that we're always representing your best interests. Securities offered through Vista Point Advisors, member FINRA, SIPC. This has been provided for informational purposes only. It is not intended to address all circumstances that might arise. Testimonials from past clients may not be representative of the experience of other clients, and there is no guarantee of future performance or success. Clients are not compensated for their comments. If you have any questions about the process of selling your business or raising capital, reach out to a member of our team, or check out the For Founders section of our site by visiting forfounders.guide.